Surprise, surprise. Yet another European debt crisis and sequence of summits concludes with a deferred decision, more extend and pretend. Call it what you like, but the Eurozone's latest dance to the tune of Greece isn't over yet. Hello, I'm Russ Mould, AJ Bell's Investment Director, and this is the latest edition of Breaking the Mould, our regular look at the financial markets. Now, ever since the Syriza party triumphed in the Greek general election, which took place at the end of January, investors have been wondering what this means for the euro and for European stocks. The answer thus far is, in fact, not a lot, certainly nothing bad anyway. To start with, the currency has actually gained a little ground against the dollar since the election result, as the chart behind me shows. Eurozone equities, meanwhile, as benchmarked by the Euro Stock 600, have also kept their nerve relatively well. The chart behind me shows performance in local currency as actually quite a gradual increase. Now, this may seem surprising given the uncertainty, but remember that just 3 days before the Greek ballot, the European Central Bank announced its own €1.1 trillion quantitative easing scheme, QE. The electronic money printing, bond buying project launches in early March, as ECB President Mario Draghi finally delivers on his summer 2012 promise to, and I quote, to do whatever it takes to preserve the euro. Now remember, there's no fiscal or banking union in the Eurozone, just monetary union, and all three are really needed for the single currency to work in the long run. For the moment, the euro is therefore as much a political construct as an economic one, and given the amount of financial and political capital invested in it, the ECB and Europe's leaders will not let it go without a fight, or for that matter, a few fudges and rule changes when necessary. Greece doesn't want to leave the euro, the authorities don't want it to leave either, which makes the decision on Friday the 20th to give Greece an extra 4 months to sort out its reform programme and how it intends to address its huge debt pile no shock at all. Again, pretend is all okay, and extend the deadlines is what Europe's been doing since the true extent of Greece's liabilities became apparent 4 years ago. So really, we're looking at no change. But in the end, there are only 3 possible solutions, just the same, in fact, as if you or I owed the bank £323,000 that we couldn't pay back, let alone Greece's €323 billion. Scenario 1, Greece defaults and says it can't pay, which, let's face it, is actually an accurate reflection of the facts. Scenario 2, Greece and Europe reach a big grown-ups deal whereby Greece manages to pay back some of the debts at a lower rate over a longer period of time to give it a chance to get back on track. The third option is we carry on as we are. More deadlines, extensions, threats, counter-threats, no solution. That's the worst of all worlds and effectively where we are now. That may in some ways make the calm reaction to the latest fudge a bit surprising, but again remember what canny Draghi did just before that Greek election result. He got in first with his big bazooka. Few, if any, hedge funds or pension funds will want to take on the ECB's liquidity, and we can see from America in 2008, behind me here, the UK since 2009, which is the next chart, and then the final graphic, which is Japan since 2013, how central bank QE can lower bond yields, suppress interest rates, and then ultimately, from these charts, drive cash into other assets such as shares and equities looking for a home for better returns. Now, the best performing regions in local currency terms over the last year are Japan and Europe, where central banks are at their most active right now. The only issue is local currency, because although the local currency index has been good, some of that performance has been lost to falls in the yen and the euro. Now, investors who want to ride the wave of liquidity and feel these regions meet their own individual investment strategy in terms of time horizon, target returns and appetite for risk might consider hedging out any currency risk by buying an active fund or a passive tracker that offers return in sterling terms. So at least that's one less thing to worry about. Anyway, that's it for this week, and I look forward to seeing you next time.